following the balance sheet of ZMW Limited for the year ended 31st March 2015. Please excuse the grammar, couple of places. Okay, following is the balance sheet, and even going forward, right? Remember, this is following is the balance sheet. Okay, and going forward, we have something written here called capital gravity ratio. Feel free to Google. There is no such thing on earth called capital gravity ratio. Right? What they meant was capital gearing ratio. Okay, so I'm going to make that change here. Gearing ratio. Alright. Now, they've asked us to calculate these ratios, and they've also asked to prepare a vertical balance sheet with sources and application of funds. I suggest you'll read your question very carefully. If they've not asked for the vertical balance sheet, no need to make the vertical balance sheet. Okay, so because they've asked and a lot of students in different courses will have it, I'm going ahead and doing it. It's very quick, and then we'll proceed with the ratio calculation. Alright, so for those of you who directly want to watch the ratios, please fast forward. We have particulars, okay, and we can make do with two amount columns. Okay, so particulars, let's see. Alright, particulars, amount, and again amount. Okay, I am dispensing with neatness. This is just for your understanding. Alright. Your title can be the name of the company, so ZMW Limited, and balance sheet as at 31st March 2015. Okay, please make sure that your format is much more neater than mine. Okay, 2015. Please and full. Now, going forward, we have sources of funds, and at the bottom application of funds. It's a very short and sweet balance sheet. Okay, under sources of funds, most of the stuff that you see on the liability side. So we have under sources of funds, we have own funds, under which we've got share capital, which is 80,000, and reserves and surplus, which is, and they only calling it reserves, so reserves, which is 20,000. Right, that's it. We have 1 lakh in the outer column. Next, we have borrowed funds. Okay, borrowed funds, and only one item in borrowed funds, which is 10% debentures. Okay, so 10% debentures, which I'm directly putting in the outer column because there's only one item. Okay, 25,000 rupees, 10% debentures, and therefore total capital employed is equal to 1,25,000. Okay, why have I not done anything with current liabilities? Because it comes as a subtraction to current assets under the application of funds section. Right, so under application of funds, we have fixed assets, and let's see what we have. Just two items, fixed assets. Okay, so you can have non-current assets, under which we have only one item, which is fixed assets. And the fixed assets is 75,000, current assets is 1 lakh, fixed assets is 75,000, and again I'm directly writing it outside because there's only one item under non-current assets. Under current assets, okay, current assets, we have to write it in the inner column because we will write current assets minus current liability. So it's going to be 1 lakh less current liabilities, which is 50,000. Okay, remember it's negative, so we write it in brackets. Okay, so we end up with 50,000 outside, and we add that to 75,000 and get the same total, which is 1,25,000. So our balance sheet tallies. Okay, so again we can have total capital employed or total funds utilized. Either way, it doesn't matter. Now, going forward, dealing with the ratios. The first ratio is current ratio. Current ratio is equal to current assets upon current liabilities, right, which in turn is equal to 1 lakh upon 50,000, which gives us 2. Therefore, our current ratio is equal to 2:1. Okay, and I'm just going to make a copy of whatever we have here so that we can easily refer to it downstairs without scrolling up and down. Okay, so here we go. Our next ratio to be calculated is the proprietary ratio. Okay, so keep in mind the formula for proprietary ratio is equal to proprietor's funds upon total assets. Okay, so that in turn is equal to proprietor's funds is as good as saying owned funds. Okay, and total assets, we already know what is total assets. I'm just expanding on the formula for proprietor's funds. Owned funds, we have already done it in the balance sheet, and even offhand you should know. Okay, owned funds is nothing but equity share capital plus reserves and surplus. In this question, we've been given equity share capital. We're just calling it share capital and reserves. So I'm just going to write 80,000 plus 20,000 upon the total assets, which is here. Okay, 1,75,000. So we've got finally 1 lakh upon 1,75,000, which is equal to 1,75,000. Okay, 0.571, just 0.57 is enough. Okay, is equal to 0.57. Right, so therefore proprietary ratio is equal to 0.57. You can write that down. Okay, so now I am going to continue here. Our next one is the capital gearing ratio. And keep in mind, capital gearing ratio formula, capital gearing ratio. It is similar to debt equity ratio, but not exactly the same. Many times you'll get the same answer though. Capital gearing ratio is capital with fixed return upon capital with no fixed return. Okay, so what is this capital with fixed return, no return? Think about debentures, we have to pay interest. Preference shares, we have to pay preference dividend. These are forms of fixed return. Reserves and share capital, we don't have to pay dividend. If we want to, we will. So that is without. So it's going to be 25,000 upon 1 lakh. Okay, so anyway I'm substituting. It's equal to 25,000, which is our debentures, upon equity share capital plus reserves and surplus. Okay, which gives us 0.25. And now we can go ahead and calculate the gross profit ratio. Okay, and keep in mind, gross profit ratio is equal to gross profit upon net sales into 100. And do we have it given to us? Gross profit is over here. Always remember, sales minus cost of goods sold gives you gross profit. Okay, so gross profit is given to us on a platter. We have 90,000. Net sales is 2 lakhs. So it's going to be 90,000 upon 2 lakhs into 100, which is equal to 90,000 upon 2 lakhs into 100. Do it on the calculator, you get 45%. Okay, so we can say, therefore, on the next line, of course, therefore, gross profit is equal to 45%. Now, our next ratio is the return on proprietor's equity ratio. Okay, so proprietor's equity, you need to keep in mind that you're starting off with sales. Okay, you are subtracting cost of sales or cost of goods sold, you get yourself gross profit. Okay, and once you subtract your operating expenses, okay, you will end up with either operating profit or what these guys are calling net profit before tax. Okay, after which you can subtract tax, okay, and you get net profit after tax, which is 15,000. These guys have forgotten to write it over here. So anyway, net profit after tax is 15,000. Then your dividend, okay, minus the dividend is 8,000, and then you end up with what is called retained earnings. Now, if there was preference dividend to be subtracted from net profit after tax, we could have done that and got ourselves earnings available. Since there's nothing, it is zero. That means our net profit after tax is the same thing as earnings available to equity shareholders. The formula that we have here, return on proprietor's equity ratio. Okay, return on proprietor's equity ratio is equal to earnings available to equity shareholders upon owned funds or funds invested. Okay, so we are looking at 15,000, which is net profit after tax. Keep in mind, earnings available is what? Net profit net profit after tax, earnings available, is equal to net profit after tax minus preference dividend. Preference dividend is 0. So the same net profit after tax being 15,000 is what we'll substitute downstairs, divided by the own funds, which we already know is 80,000 plus 20,000, which is a lakh. Okay, so we get the return on proprietor's equity ratio as 15%. Now, are we missing anything? Net profit ratio. Okay, net profit ratio is straightforward. We have ourselves net profit after tax, okay, and we have sales. So net profit ratio is equal to net profit after tax, or what we call NPAT, after tax, in brackets NPAT. Okay, one more time, NPAT upon net sales into, okay, into 100 into 100. So our net profit after tax in the question is 15,000 again. Okay, 15,000, sales is 2 lakhs. So we have 15,000 upon 2 lakhs, which gives us 7.5%. With that, we are done with this question. Okay, if you all have any doubts, feel free to place it in the comments.